Okay, so let me start with chapter 10. As we move into chapter 10, there's going to be several things we're going to talk about in this chapter. Mostly this chapter is about liabilities. So things that we owe, we'll talk about short-term and long-term liabilities. We have pensions that we will have to pay. We'll also have to pay payroll and then vacation pay also. Those are some of the areas that we'll be taking a look at here. So just because employees accrue a vacation pay, we do have liability for that. Also with pensions, we make a promise to these employees over the time that we will pay them whenever they retire. So you'll get a little more detail on that. We're going to be real simple when we talk about pension. We're just going to journalize those. We're not going to go into detail and figuring out how much we have to figure out, what the present value of the dollar is, and all that good stuff. But we'll talk a little bit about those things. And then also, the thing that we like to look at, it's called our paycheck, the payroll registry, and what comes out, how is that figured out, and we'll work a couple problems that we'll really take a look at what is pulled out for federal and those type of things there for us. All right, so let's take a look at the first problem here, which is on 10-1A on page 476. An example of this is on page 453 if you want to take a look at the problem, an example of that. So the problem asks us, on October 12th, Belleville Corporation borrowed cash from Texas Bank by issuing a 30-day note with a face amount of $70,000. Determine the proceeds of the note, assuming the note carries an interest rate of 6%. Well, what's the proceeds of that? What are we getting with that note? How much are we getting in for that with that note? They're giving us how much?
70,000.
So it's 70,000. That's our proceeds. So they're giving us 70,000 as a part of that. So that's our answer to 1A. Real simple as part of that. Now the second question is a little different. And so this is where we're about to dig a little deeper into this. It says determine the proceeds of the note, assuming the note is discounted at 6%. That means they're giving us a discount on that. They're going to give us so much, and at the end of the time, after 30 days, we have to pay them 70,000. On this one here, we have to pay them 70,000 plus the 6% interest for 30 days. So on this one, we got to figure out, okay, they're discounting it, so they're not only going to give us 70,000, maybe 69 something or something like that. So to figure this out, we take the 70,000 and what we're going to do is we're going to multiply. How many days is it? This note? 30 days. So when it's the 6%, that's an annual interest rate. So we've got to figure out what it is other than annual, which is, so we'll just do it, it's almost like a monthly. So basically we'll take that and then we'll multiply it by the 6%.
Is it 360 or 365?
Let me see if they took the 360 or 365 here. Usually they'll do 365, but sometimes in our stuff, they make it easier. They made it easy on this one, 360. That's what I thought they did. So just make it 360 on this one. To make round numbers. But normally no, but it's 365.
So I have a question.
Sure.
I'm not understanding that because A says A is 70,000, but wouldn't that be? It says assuming the note carries an interest rate of 6%. Wouldn't you have to add the 6%?
But what they ask us is, what are the proceeds? What do we get from that? And that's what we're concerned with.
But so the B also says.
What are the but they're giving us a discount. They're giving us the discount of that. So what we're basically asking, what are the proceeds? What are we getting from this? Is we would pay them more than 70,000 for us, but they're giving us 70,000. That's all we're worried about in this when we say proceeds. What are we getting in this?
Okay.
And so on this one here, we're getting this.
So wouldn't you just get it, if it's 6%, if we're getting a 6% break off of that, wouldn't it just be 70,000 times 6%?
But we
I don't
only
see
do it
where
for
they're-
30 days.
But that doesn't matter, they're dividing, or they're only giving you 94% of the 70,000.
No, they're giving you just a portion of that, because it's only, that's 6%, so really it's a 0.5%.
But we're not But the thing is a 30-day note, it's not an annual note.
I know, but they give us the interest rate as a part of that. So they give, the interest rate they gave us was 6%. Now, if we were to figure out what that interest rate is per month, it would come out to be 0.5%, right? Because we're dividing, yeah. And so that's basically what we're doing, is we're gonna take 0.5% of this, because that's what we can figure it out to be, for the 30 days. So that's what this basically does, that 30 days divided by 360.
Can you go ahead and just multiply the 70,000 by 0.5%?
You could, yeah, you get the same answer, yeah.
All right.
It's just, I'm just trying to show you how to, it lays out for you. So, because you may have a different one that says, maybe it's 60 days, and so, which would be 1%, but that's, you know, you would,
Right. Okay.
so what do we come up with there? Because we're gonna take it away from that 70,000. So you're gonna take this answer away from this.
So it'd be basically 69,650.
69,650. So that's what we would get as a part of this loan. And at the end of the loan, at the end of 30 days, we pay the $70,000 because that already includes the interest in it. So they just gave us less. So some loans are that way where they give us less than what it is, and then we owe that much at the end of it. Or versus this way, we would have paid them, it looks like we'd have $350 we'd owe them for that. So we pay them $70,350 at the end of this one. It's like $70,000 here. How we doing? A little confusing. Questions? You're not going to answer? So again, this is just what we are getting because it's proceeds. What are we getting from this? So we're getting 69,500. We're receiving that. We're receiving the 70,000 that portion. What we owe is a different story. But the question asks, what are we getting? All right, let's do the next problem, which is 10-2A. So this one's different direction. Let's talk about payroll. So I'll let you read through the problem. And Exhibit 3, can't remember the page it's on, I'm going to pull it up real quick for you. It's in the chapter.
455.
455. That's right. All right, very good. That's on page 455 you can turn to. That's right, it gives it to us too also. We got to talk that. So this one, what we're going to do is figure out, well, what's the federal withholding for this person here? Now I'm kind of putting it up there for you to take a look at. So it tells us, the question tells us, as we read through it, that this gentleman receives $2,400. Let's check. He's claiming 2 exemptions.
26,600.
Or 2,600, sorry. Thanks for catching me there. 2,600, claiming 2 exemptions. So we multiply it by the allowance they give us, which is 70. So that's 140. So that gives us a total of 2,460. That is subject to withholding. All right. So So since that's subject to withholding, if you look on the on that page on 455, you can kind of figure out everything. So you'll see a portion there. You can see how it's highlighted in there on 455. You'll see a portion there where it says, okay, if they fall into this but not over this, they hit this much. So as you can see there on 455 on Exhibit 3, it's over 1648, but not over 3394, right? So that's the category we're going to use. So because of that, this person gets $327.40 is part of the tax, plus 28%. Now to figure that out, there's an example there. You can look at some of the examples. So this is our initial withholding, and then we have the 28%. Now the 28% is not off of the whole thing. We had 24,000, or 2,400, excuse me, and then we had 1648, right? Because that was the limit we took it up to. So it's over 1648. So that's the in excess of 1648, and that's what we'll take the 28% on.
Where are you getting that number from?
Which one?
The 1648?
On that chart on 455. Yeah, Exhibit 3. So in Exhibit 3, it shows us at that point, in excess of that, we get the 28%. That's what we're hitting with.
Okay.
You able to see where that's coming from? So we'll take this 28% of that, which is how much? $227.36. All right. And actually, the question asks us, what's the federal withholding? We'll just total those up there. Which is 76.55. So $554.76. That's what we withheld. Obviously, that's not the only thing that is taken out of our paychecks. But that kind of gives you a kind of an idea of that. Obviously, there's other things that are in the paychecks that we don't that are on there. You also have the state withholdings, which is SUDA. And that's your SUDA. Our friends, like
So
and
as far
HR
as
now.
like the exhibit or like the bracket that we want to use for it, because the 2460 was over the 1648, but it didn't hit the 3394 is why we used the 1648.
Exactly.
So if it would have gone over the 3394, but not over the 73, then we would have used
That one, and then we can
Okay.
do 33%. So it depends on where you fall into in that.
Okay.
So that's how it kind of breaks down. Questions on how we walk through that problem? So that'll be similar to one of the problems you'll have in the homework. Oh, I think it's the second problem you should have. So So it should be similar to that one. No questions? Not too bad? Something that we look at, we kind of have an understanding of? Good? All right, let's take a look at 10-4A. Now we're going to journalize these as the employer. So we're looking at it as the employer. Now, we collect a lot of stuff for our employees, the taxes. So because we collect those things, what are those going to be classified for us as? Because we collect the cash for it, or not cash, we didn't pay it out yet. So it's sitting in our cash.
Tax expense.
Yeah, so it'll be an expense. Yeah, so it'll be a payroll. But what is it to us though also? We're gonna eventually have to pay that, right? We eventually have to pay give out their withholdings and all those good things. Just remember those sales tax we had. So we're holding it for only a short term. So it's a liability to us. It's a short-term liability to us. So each of the things that we have in there, like Social Security, Medicare, those type of things, are all going to be, and salaries expense. Those are all. The other ones will be the payables, what we owe. So I'll let you guys take a look at it. So on 10-4A, which is on page 477, a good example of that is on page 459. Now the reason we put these in salaries expense, and that's what I started off with here, is because that is an expense to us as part of the salaries. We are committed to having to pay these things. And so we pay portions of the Social Security of our own, because the employee pays part of it, so do we as the employer. And then we also pay unemployment taxes and other things there. I don't know if this problem has unemployment, but we also pay those type of things also. And so those are expenses that we have towards our salaries, even though we're not giving those to the employee, we're going to somebody else. But they're still as a part of it, our salaries expense. Does that make sense? Okay, so what do we have? What are we going to put in here? So since we're at this expense, we debit the expense, and the rest of them are liabilities, right? So which is the first one we have?
Social Security,
Social Security.
or 13,200.
13,200. And we'll put it as payable because we owe this. Okay, what else do we have?
3,300 Medicare.
Medicare. Okay, 3,300. All right. What else do we have? We have 4. Federal withholding. Yeah, which was that?
43,560.
43,560. Okay, and then lastly, we have one more, I think.
43,560. So there's a 0.
5. Oh, gotcha. 43,000.
Yeah, sorry.
All right. Are the other ones right? The other ones not good, right? Okay, let's see.
Total salaries.
Okay, so salaries, total salaries. Okay. Salaries. How much is that?
220,000.
Even?
Yep.
Okay. All right, then we'll add all those together, and that will give me my total salaries expense. Let me double check here.
Does it matter what order it goes in? Because the total salaries came before the federal withholdings, does that matter?
No, it shouldn't matter too much, but the total salary should be, that should be the salaries expense, as we look at it there. So the The salaries payable is what we want to figure out what to be. They kind of worded this a little weird. So this should be 220. All right, and so this here is their salaries payable, what we're going to pay out. All right, so we have salaries payable, and basically it's a 220 minus this, this, and this is what we paid out in our salaries. So what do we have for the salaries? 160, isn't it?
159, 940.
All right, 159,940. So that's how the journal entry would be. They gave us the salaries expense there. They gave us that. We just had to figure out what the salaries payable was. They said total salaries. That's what they meant by that. Pretty simple journal entry again. These are all liabilities. That's why we are crediting those. We're adding to all of that, and then we're adding to our salaries expense, which is why we debited it. And so that will take away from our net income. And then add to our liabilities what we owe. So questions for that one? All right, let's move to 6A. We've got a couple more problems. Like I said, the last one will take probably about 20 minutes or so, or 25, depending on how quickly we need through this. Lots of journal entries. So on the bottom of page 477, it tells us that the employees earned vacation pay at $19,500 for the period. So that's the first thing it asks us to do is vacation pay. Does anybody have any ideas of how we would journalize this? Now remember, we owe this to them.
What's an expense?
We'll have an expense, so vacation pay expense. And it was 19.5. And then we have a liability too, because now we owe this to them. We've expensed this out, but we have a vacation pay payable. Now we're going to raise up our liabilities because we owe that to them, and then we have an expense that's going to lower our net income. So questions on how I came up with that one? All right, the second part of the question that asks us says pension benefit. That's what we have to figure out. So the pension plan requires a contribution to the plan administrator equal to 6% of the employee's salaries. Salaries worth $260,000. So basically, what we're going to do is it's 6% of the $260,000. That's what the amount is we're going to have. Okay, and 6%. I'll just write this over here so you can see that. So 260 times 6%. Was that? Yeah, sure.
15,600.
15,600. So we have to pay this into their pension. So it's coming away from us because somebody usually outside of the company handles the pension. They may have a third party that handles that. So we're going to pay that. So we have an expense called pension expense for that amount of money. We also then, we gotta take it, what are we gonna use to fund it?
Cash.
The $90 cash. And that's what we're gonna take it out of. Because we are funding it, and they're not putting any money into it, we are funding it. So we're paying $15,600 as part of that, and then we have an expense that will lower our net income, because we're paying that out. Because part of the benefits of being an employee in our company. All right, you guys ready for the last one? Been waiting for this one? All right. All right, so P10-1, PR. As you can see, we just have lots of transactions here. I will give you a few moments to review them and start to put together your journal entries. It's not so bad. It really isn't. All right. So basically it asks us to journalize the following transactions. So on February 3rd, we'll just walk down each one of those. We purchased merchandise on account for $410,000. All right, so February 3rd, we purchased merchandise. Yeah, that's what's our merchandise inventory. Remember that from chapter 5? I don't remember what chapter that was. And then we're doing it on account, it said, right? So that's our accounts payable. So we have, and I'm going to call that AP here. And that, I can't remember the name of that company.
Oh, the fade.
The Fade? Okay. All right. That was 415. 410. Be straight. So that's what we would journalize there. Questions on what we did? Pretty simple. Okay, now March 3rd issued a 45-day 6% note for the 410. So, all right. As you can see, our 30 days expired. That's why we're doing it on March 3rd. So now we're transitioning this. We're taking it out of accounts payable and moving it over to notes payable. Okay? So how do we take it out of accounts payable? This is a credit, right? So that we debit it, yeah. So we're going to debit that. And then we're going to put it over to notes payable. We are just transitioning it over. And the reason being is they're giving us a little additional time to pay this thing, but they're going to charge us some interest. So now we've transitioned into this. All right, questions on what we did right there? The next question, the next journal transaction on April 17th, so now it's been 45 days, we paid the company the amount owed on the note. All right. April 17th, today's date? All right, so on April 17th we paid this. Well, we just didn't pay the 410, did we? Right, because we have interest. Now they're charging us 6% interest on this. So we got to figure out what 6% is going to be, too. So our notes payable we know is 410, right? And we're wiping that out. We have interest expense. And then we're gonna pay that with cash. Now we gotta figure out what that interest expense is gonna be. So to figure that out, remember what that thing we did, I don't know, it was the first or second problem we did there? We're gonna do is 45 days. So we're gonna take that 410. I think they did it on 360. Usually they tell you that. Is it on 360? Yeah, they do on 360. So 45. And then 6%. That's how you figure out what the interest will be paying up there. So it's basically coming out to be, it looks like about 0.75%. No?
So why
Yeah,
aren't they
those
doing
units,
the
yeah.
360?
Yep, so- what's that?
Why are they doing the 360 and not the 365?
Just to make it a little easier on us.
Okay.
Yeah. Is that 3,075? So that would put this over here at 413,075. Yep, looks good to me. So everybody figured out how we got that? So we're just figuring out what the percent of the interest is on that portion. Questions?
Yes, when we're doing our homework, we need to find out the interest expense, how many days are we working with?
For this one here, it's at 45, because that was a
No, I
note.
mean, as far as the number of days.
Do 360. It'll be the same. It should be the same as
Okay,
this.
that's why I was a little.
Yeah, just use the 360. It looks like they're using that throughout this portion.
Okay.
So yeah, just then I'll make it
And in the
easier.
real world, it would be 365.
Yeah, pretty much.
Okay.
But they want to make it easier on us to figure things out,
Yeah.
because 365 gives you a lot of numbers.
Okay.
Yeah. It's close enough. Yeah, all the homework looks like it's 360, so. All right, so questions on how we figure this out? All right, so the next transaction we have to do says that on June 1st, we borrowed $250,000 from Elheiser Bank, issuing a 60-day note at 7.5%. All right. So, on this, all we're concerned about is what happens with this. So it's June 1st.
Yeah.
We get, what are we getting in? $250,000. Lincoln. All right. I'm getting cash. And then I have a note. And you can put the company's name if you want. You don't have to. I didn't have to put it up on the other one either. Those people that give you those $1,000. So you get the cash in for $250,000. That's what we'd write. And that would be that journal transaction. Now, at the end of it, we'll pay cash out and include interest expense on that at the end of 60 days, so August 1. That's what we'll have. All right, questions? I'm going to raise the top two, and, so I can have one room to work. All right, so the next transaction is on July 21st. Purchase tools by issuing a $300,000 60-day note to Nash Corporation, which discounted the note at the rate of 8%. All right. So we're getting, what are we getting in here? tools in. Tools. Do we pay cash for it?
No, it's notes payable.
Notes payable? Okay. That's what we're paying notes payable. Now, because they're discounting it, what we're gonna put that as is interest expense. And we're gonna do it now, since they're discounting it. Because our notes payable will be the full 300,000, right? Not 30, 300. So we've got to figure out what the interest expense is going to be, because they're discounting this to us. So I'll give you guys a moment to figure that out.
So you kind of do this, well, you do it pretty much the same
The
as.
same way,
April
yeah.
17th.
He was 60, right? 60 days,
Yeah.
and then 8%. Let me switch over the pins here. Is that 4,000?
Yes.
Okay, so that would make this 296. And that's what we're getting in tools wise. We're already figuring out what the interest is gonna be. So at the end of this 60 days, we will pay $300,000, and that includes the interest already. We've already figured it in there. So that transaction at the, September 21st.
So we went to go buy, when we go buy the tool, when they go buy the tools, they know that they can only spend 296,000, not the 300,000.
Yes, exactly. So that's what they got the value of the tools, yes. Because they've already configured in the interest on that, yeah. All right. So that is the 21st. So on the 31st, they paid the interest due on the notes on June 1st, to that other company, and renewed the loan by issuing a new 30-day 9% note of $250,000. All right. So what was the interest?
9%.
I mean, do you guys remember what the
7.5.
7.5%? Okay, so on the 31st here, we have notes payable. How much is note payable? 250? Okay, and then we have interest expense here. To figure that out, we're gonna take 250. Times, what was the original program? 60 days? Times 7.5%. That was the original interest. So what I'm doing is basically I'm renewing it here. Cancel one out, kind of put another one back in. That's all. And then I'm paying the interest expense. So what was the interest expense on this?
I got 3,000.
1,125? All right. So that's what we'll pay in cash. We pay that interest expense, just basically renew this. Now remember, this is going to be at 9% as we move forward.
Okay, so you have two, we have two entries there, notes payable.
Yeah, we cancel out one by paying it off, and then re-upped it again over here. So we cancel the original one and then and put it back there again, and we have notes payable. That's what that is. So it said we renewed it. And that's all that transaction is there. Okay, I'm gonna erase the bottom part here. So move forward.
So is there a better formula than that 360 thing that we can use? I mean, cause like.
I mean, honestly, you could probably do it by months if you want to. The problem is when you get into 45 days, it makes it a little harder, but you could do it by months.
So like, let's.
Because in my head, I do like this, I would do, now it's 1/6. So.
Right.
Yeah, you know.
1/6 of 7.5%.
Yeah. So that's what I would do in my head.
So essentially, would that be like, I don't know, you just take the 7.5.
You probably would,
by 12.
1.25, so it'd be 1.25% is what you want, like, I think, if I did that right in my head, but that's what you'd have. And you just multiply that 1.25% times 250.
Okay.
And then you get that. Just so you can visualize it. All right, so the next transaction we only have 5 more. So on August 30th, we paid the bank, yep.
Sorry, I have a
Yeah, go ahead.
question. The last part of, on the July 31st, do we have to do anything with issuing a new note?
That was what we did here.
Is that?
Yeah, we canceled out this one by debiting it.
That's based on 7.5%.
Yeah, it's the same, it's just to be a different note. We can put like 9% here if you want to, but then you usually don't do that in transactions. This is the
Oh, okay.
7.5 one, the 9.5 one. So I basically got rid of this note, because remember that had a credit way back where, whatever it was.
Right, yeah.
And then now I have this new one at
Okay.
9%. And that's what that transaction kind of was.
Okay,
Yeah.
sorry.
No question. That's good. All right, so this question is, see, on the, so we paid the amount due on the note of July 31st. So we have to pay the amount due on that. We did a 60-day note on that? No, we did a 30-day note, okay. So we did a 30, so since we're paying that, what we owed on that note. So we have to do our notes payable. We are gonna get rid of this 250 for the last time, I hope. So we're gonna get rid of that. We have to pay interest, right? And how are we gonna figure the interest? We're gonna take the amount times 30 days, which is 1/12, and then that's off of 9%, right? Which should come out to be 0.75% over the time period. If I did right here, I don't know. So what do we come up with on the,
1,875.
875, so this gives me 251, 875. Good. So questions on this one? Now we wiped out that one, we wiped out this note again, now it's gone. We've now taken the interest and we paid out that much money. All right. 3 more, we're in the home stretch. All right, so on December 1st, the office equipment from Osocor,
Oh, September 19th.
did I skip that one?
Yeah, that was like 3 more. Only 4 more.
Oh, did I miss that one? I did miss that one, okay.
Bummer.
All right, so September 19th, yeah, I'm skipping things now. Paid Nash Corporation for the amount due on the note on July 21st. So what are we doing there? I'm gonna erase these top 2.
So are you debiting the notes payable again?
Yep. For how much? You think?
300,000.
That's Sounds good to me. Right on. Good job. Because we already paid, remember we set that up, that's what we owed them. And then we'll just credit cash. We'll pay it out of cash.
So we don't have to do the interest?
Because we already did that the previous, yeah, we already did it, yep. Yeah, we already figured it out what it was gonna be. So, we don't really need more interest.
Thank goodness.
All right, now we have 3 left. We're really not in a rush. All right, so on December 1st, purchased office equipment from Oso Corp for $340,000, paying $40,000, so we paid $40,000 in cash, and issuing a series of 10 8% notes for $30,000 each, coming due 30-day intervals. All right. Well, I'm walking you guys through this because if you see this on the homework, you'll know how to do it, right? All right.
Now we will.
No, we're not talking about you, we're talking about the
They're being. All right, so what are we getting first?
office equipment.
Office equipment, sounds great. So we're getting office equipment in. And how much are we getting of that? $340,000, okay, good. And so the next thing we have is, we have notes payable, right? How much notes payable do we have? We have cash. So we have $40,000 in cash. And then we're gonna owe $30,000 on notes payable, right? We put down $40,000 in cash. Then we owe notes payable. Yes, it's 10 installments we're gonna be paying on that, $30,000 each. But that's our notes payable, that's for that transaction. And it raises here.
so they just make it sound more confusing than what it is?
Yeah, well, it means some things later on,
Okay.
as we head into this portion of it. Actually, at the end of the month, we'll have to figure that out. That's all it means, but it doesn't mean a lot to us right now, because we still owe this. So just at the end of each month, we have to pay them plus interest. That's all. $30,000 for 10 months, we're gonna do that, so. All right, so let's look at on the 12th, December 12th. Settling a product liability lawsuit with a customer for $165,000 payable in January. So we're not paying it till January, okay? They accrued the loss in the litigation claims payable account. So we're accruing that in the, so on the 12th, we had a litigation loss. And then we have litigation claims payable. Because that's where we're gonna put it. We haven't paid it off yet, because we don't pay it for the next year. And we have a loss that we gotta take. And that'll come into your other items, extraordinary items that you have in your statements. You'll learn about that in another accounting classes. All right. Just 2 if you're in business. It won't be in that class, you'll learn about that. It's good.
So,
Is that?
which is, in your opinion, which is easier, this class or the managerial?
Depends. It depends on you a little bit. A lot of people like the managerial a lot better. I personally am more managerial side because I did a lot of that, so I'm real familiar with that because I did that for companies. So, but I'm also managerial, the financials not so bad. In some ways, it's just the beginning of everything. It's the financials becomes tough. Managerial, you're starting to get it. You can sort of get the flow of things. You do a lot more ratios, figuring it out. What should we do? Kind of stuff we looked at a little bit a couple chapters ago. So, but I find a lot of the students like the managerial a little bit better. So sometimes it's not as bad.
It's that ratios one. I'll take this one. Those ratios are killing me on chapter 7.
All right, so last journal entry we're gonna make. So we paid the amount due to Oso Corp on the first note in a series issued on December 1st. So we're just gonna journalize the first one, right? So let's figure that out. So just like the ones we've done in the past, we have our notes payable. How much are we, what's the notes payable? What are we gonna debit that for? Any ideas?
Would it be the 30, yeah, the 3,400,000 there, wait, no.
So we're just doing one.
Yeah, we're just doing 1 month. So we had 10 of those, so it'd be 30,000.
Okay.
So that's all we're doing is at the end of the year, we're gonna do that first one. And so then what we gotta do is figure out what our interest expense is gonna be. So again, 30,000 times 30 over 360, which is 112, and that was at 8%?
Yes.
8%, okay. So 8%. We'll figure out what that's gonna be. So 112. That's 200. All right.
Yep.
It's 240. Yeah. Okay. And that will give us, what we're gonna pay out is 30,200. That's what we'll pay. And so this tells us what we're gonna pay for the next 9 more months. But we're not gonna do all of those. That's it. I think, right? Or is there more?
Yeah.
Oh, is there? Okay,
Number
so,
2.
oh yeah, number 2. So we did the first part of the question, and we have the last part here. So the last part of the question is to journalize the adjusting entries for each of the following accrued expenses at the end of the current year. So we have a product warranty cost of $32,500. So I'm going to erase the top 2 here. So what do you think that goes into? Thoughts?
Product warranty expense.
I like it. That's good. And then what was the amount on that? 325. Okay, now what is going to be my credit? What do we owe it? Because we're not paying cash out for it right away. So it's going to be basically product warranty payable. That's all. Yeah, that's 32.5. You guys can be already. All right, questions on that one? All right, now we got to do the remaining 9 months. But we're only going to just do one entry on that. So how much were we, do we have for interest expense? $200. So that's what we're doing each month. We've done the first month, that leaves us how many months left? 9. So we're going to take 9 months times 200. And so that gives us $1,800. And the reason we're doing this is so we can show what we may have as a part of that. We have a liability here, right? So that'd be interest payable. Because we want to be able to say at the end of the year, this is what we owe. This is what we have. What we're going to have. Because remember, these statements are so people can make educated decisions about how our company's doing. So we want to show everything that we've got. And then we also have expenses. So since we have that as a payable, we'll have that as interest expense. And then each year, each of the months after that, we'll start taking out a payable instead. Because we've already realized it as an expense here. And so we'll just take it, we'll debit it each time and take cash as your credits. Or that's what we do every month. Does that make sense? So no, we didn't have to journalize each of those months, but. Yeah, you might throw something at me.
I'll just be here all night.
Yeah, I'll be here most of the night, yes. All right, so that is chapter 10. That went through the long, long process of that problem. That should help you. That is the last problem you'll do in the homework, similar to that one. So it should give you a good foundation on how to do that. So questions on all that we've talked about today? You guys feel pretty comfortable with chapters 9 and 10?
Seems a little bit easier than the last two chapters we did.
Yeah, not so bad. LIFO and FIFO
Yeah.
are one of the hardest ones. The concept, yeah. Some people can grasp it, and some people, I mean, I struggled with it when I first got it. I was just like, whatever. I'm trying to picture it coming in, going out. So, but.
For me, that was the easiest of all the chapters.
Really?
Yeah.
Well,
But I
you're
do
lucky
that-
one.
But I do that every day.
Well, there you go. That's true. Yeah, that's true. All right. Well, thank you, everybody. Let me know if you have any questions.
Yeah, I'm sure I'll be